Hi, this is Mike Callahan with CMG Financial. I'm making this video today to help explain how the all-in-one loan works. I'm often asked by clients if I can just send them some information on it, but there's a lot of detail and concepts behind the scenes in the all-in-one that really deserve their own conversation. This video is meant to just kind of condense all that into a short video. And hopefully, if you like what you hear and you think there may be a benefit for you, we can talk and go over your personal scenario with it. We even have a simulator that we can run, and that simulator will show you your exact results. We can put in different variables and show how it would look for you down the road. So a little bit about me. I've been in the industry for about 25 years. I've always had a passion for helping people with their finances and getting them to a better place financially. A lot of loan officers in this industry just look at things as a one-size-fits-all approach, and I've always looked at everybody individually. I really tried to help make a difference in their financial future. I've been teaching these concepts since about 2009, and it's my passion, an all-in-one loan specialist. And so let's jump into what makes this loan different, what makes it tick. So I kind of like to set the table with things. I normally tell people, let's look back at the mortgages and where they came from that we're using today. It's all we know. Where do they come from? So today's mortgages actually came from the Great Depression era in the 1930s. There were no mortgages before that. So banks came up with a mortgage and built a mortgage to help people get into homes. But remember back then, people were living in their same homes for 30 years. They were working at the same job for 30 years. It was a completely different way of life back then than it is now. But the mortgage as we know it today was built in the 1930s and has had very little innovation since then. So the tools that we're using for housing today don't keep up with today's lifestyle because they were created 90 some years ago. Basically, the banks got together and said, let's create a financing instrument for homes. So they came up with a 30-year mortgage, but they made it amortized. And what amortization is, it's a mathematical calculation that we have for mortgages, we have them for cars, most loans. And an amortized loan is a fixed loan, a fixed period of time, but your payment stays the same, no matter how much extra you send into that financial instrument, your payment's not reducing, and you're paying all of the interest up front. In fact, on a mortgage, you're going to pay more than 50% of the interest in the first 10 years alone. So it's a very inefficient mathematical model. So having said that, are we starting to see where maybe there's a problem there? So the owner of our company was over in Australia in 2002, and he saw how people were paying their homes off much, much quicker than they were here in the United States. So he started researching these concepts. And wouldn't you know it, the United States is actually the only country in the world who uses a 30-year amortized loan. This loan that I'm about to explain to you is what's used in other parts of the world. Canada, New Zealand, Austria, Western Europe, India, they all use a version of the all-in-one loan. We're the only country that's using this old, antiquated, 95-year-old model for today's financing. So basically what we did is we reinvented the mortgage. We took the friction points that exist within a traditional amortized mortgage and we removed those. Two of the main friction points are the amortization schedule, which we talked about. You pay all of the interest up front. You're paying very, very little principal the first few years, the first 10 years. The next thing that they did to take out some of the friction points of a mortgage is we got rid of the rigid fixed amortization. So now it's been replaced with a simple interest model, a credit line that money can flow into and money can come out of anytime you want on a daily basis. Traditional mortgage, as you put money into it, you can't get that money back out of it. You have to go reapply for a loan, take out another mortgage, take out a home equity loan, create more debt to get the very money that you've been putting into that loan over time. So we sanded off those two friction points and made it much more efficient. Money can come in, money can come out, and we got rid of the amortization and replaced it with the simple interest. Think of simple interest more like a credit card. If you make a large payment on a credit card, what happens? Your payment actually goes down next month. Why? Because that payment was only based on the actual balance that you had, that you owed. What if on a mortgage, your payment dropped every month? What if your balance was dropping monthly and the payment dropped as a result of it? That doesn't happen with amortization. If you send extra money into your car loan, what happens? Nothing. You have the same payment every month. You might save a little bit of interest, but the money's trapped in there and the payment doesn't reduce. Same on a mortgage. How much more money do you want to send to your mortgage every month? The payment's not going down. Your money's trapped in the mortgage. So we got rid of those problems. Then let's talk about this, your bank account. What is your bank account doing for you today? Right this minute, what's your bank account doing for you? Nothing, right? It's not earning any interest for you. Very, very little interest. So all your money that sits in your bank account is doing nothing. So your bank account's way out here in right field, doing nothing for you. Your mortgage is way over here in left field. You're being charged tons of interest up front. We just discussed that. What we did is we put the two entities together. We integrated them, put them on this, made them in the same platform. So now we created this 30-year credit line that money can come in and out of, and we merged it with your bank account. Listen to this. Your bank account will have more money run through it in 5 years than you owe on your mortgage. Think about that. More money will run through your bank account in 5 years than you owe on a mortgage. Why are you not paying your mortgage off faster than 30 years? So now we have these two components that will work in harmony with each other instead of not even talking to each other. So imagine every dollar that passes through your bank account would now drop the principal balance of your loan down dollar for dollar. If you put $1 in your bank account today, your mortgage drops by $1. If you put $10,000 in your bank account today, your mortgage drops by $10,000. This bank account acts like any other bank account you've ever had in your life. There's no difference to it. Auto bill pay, direct deposit, wire money out of it, same features as any bank account. But all that money that you're depositing every month through payroll, through rent checks, whatever money you're putting in that bank account, it's now dropping your principal balance dollar for dollar. And that money sits in there working for you, leveraged against your mortgage balance until you need to spend that money. And then when you spend it, it comes right back out of the account, just like your current bank account does. But while it's in there, it's working for you. It's dropping down your average daily balance. And that's how this loan is calculated. Again, it's a simple interest calculation, not amortized. So you're only being charged interest on what your exposed principal balance is each day, not on the total amount you financed when you bought your home. And that is how a traditional mortgage works. You make a payment based on the original amount you financed, and that payment doesn't change. This loan, the loan is resetting itself every single month. Your payment actually goes down on this mortgage. Your mortgage balance is dropping rapidly because you're putting your entire deposits against it. Who else do you know that can put 100% of their income against their mortgage? The all-in-one loan allows you to leverage 100% of your income, 100% of all of your deposits against your mortgage, and just take back out what you need to pay your bills, thereby reducing the overall loan costs monthly and over the course of the loan as long as it runs. See, there's three variables with any sort of financing. You have the interest rate, you have the loan balance, and you have time. What we do with this loan, the all-in-one, is we remove time from the equation. By paying down the principal so quickly, so rapidly, because your bank account is linked to your mortgage, you remove time from the equation, and interest rate becomes the least relevant factor in this loan. In fact, this loan will outperform even the lowest interest rate COVID-era mortgages that are out there. I see it every single day. We have people come in who have 25 years left on the mortgage, and they say, I'm not getting rid of my 3% interest rate. That 3% interest rate still has 25 years left for you to repay it. It's just a very long repayment program that you're on. And so you're still paying a ton of interest. I often say to my clients, a low interest rate is not the same as interest saved. What that means is with any piece of debt you have, no matter how low your rate is, you want to get rid of that debt as fast as possible. You want to plug those holes up. Those holes are draining your finances. The very money going into your bank account that could be used for other things. Retiring early, sending additional money to your retirement accounts, purchasing additional real estate, buying a vacation home, buying a rental property, getting out of debt faster, putting the kids through college, paying for your daughter's wedding. Whatever it is you want to do in life, the all-in-one loan will get you there faster, safer, and it does not rely on market trends or interest rates to do it. In fact, the all-in-one loan does not change today's budget at all that you're currently living on. It reduces the overall cost of the loan, as I mentioned earlier. It reduces the monthly cost of the loan because your payments are going down every month. And that very payment that's going down is just an interest payment. Your principal is paid by your deposits going into the bank. The interest is a separate event that happens independent of that, and it goes down every month as the balance goes down. Now, let's say you need to take some money out for a large purchase. Maybe you want to remodel the kitchen. Maybe you want to buy that other piece of real estate. Maybe you need tires on the car. Whatever it is, you just peel that money back. Again, you've paid down the balance so rapidly on this loan. My average client is paying their home off somewhere between 4 and 9 years on this. I have some clients pay off their home in 1.5 to 2 years. I have some clients that might take 10 or 11 or 12 years, but the average client is somewhere between about 4 and 9 years. No change to their monthly budget. Some of these clients are coming in off 15-year fixed mortgages, 2% interest rates, and we're getting these homes paid off 1.5, 3.5, 5 years. We're taking a ton of time away. We're saving them interest. And again, these are people that had 2 to 3% interest rates. The all-in-one loan will outperform about anything out there. I like to think of the all-in-one loan kind of like driving in the carpool lane of financial life. You get to move over to the left lane. Very little is in your way. You move more efficiently. You move faster. You get to your destination the quickest way possible. Currently, just about everybody is driving in the right lane of life. There's a lot of people cutting in front of them. They have to hit their brakes. They have to slow down. They have to merge. The very nature of being in the right lane is just going to slow you down, and that is a traditional mortgage. There's nothing fast about it. It's been designed to collect all the interest up front. If interest rates fall and you're chasing interest rates, you're going to come back and refinance every 3 to 5 years, and you're going to start that 30-year clock all over again. You're going to start paying the bank all of their interest up front. I'm sure you save a couple $100s on your mortgage, but now even less is going to principal. And if you move in 7 to 10 years, which is the average time somebody moves from their home, you have to go buy another home, and you start the 30-year clock all over again there. How many 30-year cycles do you have left in your life? And that's what I ask people. A traditional loan impedes the progress to getting to retirement debt-free. So in the race to zero in life, zero meaning no payment, no interest rate, no balance, where are you at? Give me a call. Let's talk about the race to zero and how fast we can get your mortgage paid down and paid off. Again, here are the main benefits to the all-in-one loan. You have access to your home equity, your money, for the next 30 years. You do not have, it's the last loan you're going to have on your house. You have a payment that goes down every month, a descending payment, making things much more affordable. That payment's going down because it's a simple interest calculation. You're paying all of the principal upfront and very little interest. And the principal is going down by all of your deposits that you're normally running through your bank account anyway. Thank you again for your time watching this. I hope you found it interesting, and I'd love to hear from you and show you what your personalized results would be. We can run the simulator and show you how fast your home will pay down and ultimately pay off. Stop letting the banks be in control. Take control of your finances. I look forward to talking to you.